I wanted to say good morning to you live with the webcam here because it means a lot to me when I do one of these workshops, which has not been very often in the last 15 years. But one of the things that I've gotten out of it is that I've gotten to know a few of you very well. And I used to do an annual conference once a year back in 2000 and 2001 and 2002. And the purpose was that it gave me a chance to, number one, update all my research. You know, they say that the teacher always learns more than the student, and revisit what's been durable and robust, meaning what's still working and holds the tests of time, and the type of information that can be discarded. So it's also been a time-intensive way for me to organize my notes in a fashion that could be documented, okay? Because these are some of these things that we just normally wouldn't do for ourselves as traders. And along the way, for example, many years ago when I had my hedge fund, the people that ended up coming to be part of my hedge fund and worked for me, I actually met through a forum like this, through giving an annual conference, or I had a little trading room at the time. And so it's really my main connection with the outside world, because you might be surprised, I don't leave my house much. I just go to the barn and that's about it. And so this has been a way for me to touch bases with a real active community who's interested and receptive to learning. So I thought it interesting to talk about the S&Ps and day trading for two reasons. First of all, I had given a very intensive, long workshop at the beginning of the year, and it was really for people who were fairly advanced in their trading knowledge. And even then, I found that for most people, the amount of information is overwhelming. And so I thought, let me reduce things down and just present the essence. And also there's a lot of traders out there that don't have as much experience. So where do you start? Where do you go? And I want you just to remember one thing, one takeaway from here, and that is that you really only need one idea. You just need one thing that works for you. And so professional traders don't trade multiple time frames, multiple styles, multiple patterns, multiple markets all day long. I mean, even I might seem like I trade a lot of markets, but it's actually reduced down to one very simple style. So we're going to talk about different styles, different trade setups, different patterns in this workshop, but I think that you'll see that it's not a workshop about technical analysis and charts, because that's really not how the markets operate. We need to be familiar with the tools, okay? But I can, for example, show you a choice little chart formation and say all you need to do is put your buy stop here and a protective sell stop here and trail a stop, and then you'll find that that particular pattern might only come along once every 2 weeks. And our goal as day traders, at least how I see it, is that we're really still in the markets every day. It doesn't mean you have to trade every day. We don't necessarily set a goal to trade and make dollars every day, but it's more of a little bit of a lifestyle, if you call it. So you still have to have flexibility and work with the markets. And I find that especially in the last month, it's not going to come by all these kitschy little technical setups that, you know, people like to show on their charts and sell for ridiculous amounts of money, and kitschy little indicators. And then you pay a ridiculous amount for an indicator and you'll get frustrated because you find that it's really not serving you in the same way. So I'm going to put a lot of emphasis on conceptual frameworks. And what a conceptual framework is meaning that you don't have that same time axis at the bottom. And there's some types of form of intelligence that they call more along the lines of spatial relationships. And so, for example, if somebody gave you a three-dimensional cube with a piece missing in the back and asked you to pick one of 6 pieces, A, B, C, D, E, F, that would be the proper piece in the back, that's a different type of intelligence or processing. You have to kind of visualize something than a calculus equation, okay? And so the markets are very much about that type of processing. I'll just say 2 more things and then we're going to jump in to our main program. I did have a person that worked for me for a period of 10 years, and I thought he was exceptionally good with the charts. He had a great eye for the spatial relationships and just a natural feel. And he never finished high school, let alone went to college. But yet he's crazily successful today. He moved on and started his own business doing something else. And he got his start. I know if you read the Trading Sardines book, you'll have seen him referenced in there, but he got his start finishing off the interior of skyscrapers downtown Manhattan. So again, it was organizing blueprints and spatial relationships. And I just wanted to point out, he didn't even finish high school. And so it's not about that type of intelligence. You don't need a special degree. I've seen people be wonderful traders, you know, that were surf bums at one time. And so, you know, everybody comes from different walks of life, but I think the driving thing that makes people successful is when they have that passion. And if I know a lot of people have a passion for the technical analysis and a passion for the charts and a passion for following the markets, it doesn't necessarily mean that you have a passion for being a trader, you see? So you're going to have to examine that for yourself, because I've seen some people who were really good at analysis, super good, but they were not risk takers and they never felt comfortable, and they were always coming from a place of fear, and that was in part their nature. Now, there's other people that have a little bit of anxiety and stress and fear simply because it's a different medium that you aren't as comfortable with. And over time, we can rise above that. So I'm not talking about that type of fear, but we do have certain personality profiles where some people feel more comfortable assuming risk, and other people might be fabulous researchers and are going to be happier that way. So you'll have your best odds of success if you are passionate about it and you don't feel so squeamish, you know, pulling the trigger at times or just assuming some risk, because you have to trade with money that you can afford to lose. And most of you have paid for some education already. I mean, goodness knows I've paid for education. I pay for educations every single year for 40 years. So let me just talk a bit about how I started with the S&Ps and what I feel really contributed to my success. And some of these things we can do going forward, and some of them are passé, and we'll just leave them in the dust, like a lot of things with the markets. So when I started trading them initially, we didn't have software, we didn't have charting programs, we didn't even have electronic execution, we didn't even have an internet. So you know, it was very much for me a hands-on process. And I used to take a piece of paper, and every 5 minutes I would write down the price of the S&Ps, the price of the bonds, where the ticks were, the breadth, and one other piece of data that we don't get anymore called the QCHA, which was off of the Monchek-Weber terminal. So I would put pen to paper, do my periodic readings, and that would be my way of getting in flow with the day. And then I would take a pen and simply sketch out the swings for the day. And it might be a simple zigzag, an A, B, C up. It could be an open, a big V spike down and come back up, or it could be open and just a steady trend up. But the point is that I wasn't trying to graph every wiggle and jiggle. I just wanted to get the main idea right. And then at the top of the swing or the bottom of the swing, I would write down the price, and that would become my reference price. So these swing highs and swing lows are the most visible chart points in the market, and they really served as a foundation for swing trading, market people, you know, market greats from the past, and I really believe they are the most important points for a number of reasons, especially that they're the most visible. So in doing this process, initially, you start to categorize the days into several different patterns. And I learned that all I had to do was capture a piece of one of these swings. And if you had 2 or 3 primary swings that would last in duration anywhere from 30 minutes to 2 hours, in general it's 60 to 90 minutes, all I had to do was capture a piece of one of those swings. And so I had 13 to 15 swings during the week. And if I just made 5 trades a week, that was more than enough to pull out some good pocket change, because you'll find that you can start to get fairly consistent. And I also found that I gravitated towards certain times of the day. For example, some people do great right off the opening price. I do not, because try to do this opening breakout off of a 1-minute bar or 2-minute bar or 5-minute bar, I think is silly. There's so much noise and I don't want to get chopped up to pieces. So there is a way that we can trade right around the opening or even before the opening, but it's going to come by looking at the structure of the market's rhythm in the Europe session. And for example, if there is a readable bull or bear flag and so forth to get us off to the right foot. But I really found that there's 2 times of the day where on balance we have the most significant degree of trend, and then how can we capture a piece of that? So that was one thing that I did, and this was just all through my notebooks, which I still actually have today. And then when I got my first charting software program, which was the name of Insight and was one of the very first for a personal computer, I would print off at the end of every day a 5-minute chart of the S&Ps. And I think I plotted a stochastic underneath it. And I also plotted the ticks beneath it and the tickies, which, believe it or not, used to have value. And so then I would take that 5-minute chart throughout the day and I would simply go back and circle the key turning points and what they looked like. So pure deductive logic there. And it took a period of time, and you start to train your eye, and then it starts to become more automatic. So the S&Ps were first listed in 1982, and my whole learning curve for doing all this was all the way up through 1986, 1987. And I left the trading floor at the end of 1986, but I would still do this exercise of writing my notes during the day. And then when I got my first trading software, which was not until 1988, I believe, that's when I started printing off the charts. It still took me another 2 to 3 years. So my point being, even though I was a floor trader and had the benefits of lots of experience and trading activities every day, my learning curve still was a good solid 8 years. And then I found that Taylor trading technique up in the MTA library, and for some reason I just latched onto that. And we're not going to be really talking about Taylor per se, even though he has a lot of legitimate points, and we're not going to be talking about market profile. All of these things are extra considerations that we can just touch on, but they're not essential for our purpose of this workshop. But what I did find was that there is a certain validity to get the main idea right. In other words, do we want to approach the day from the long side, or do we want to approach the day from the short side, or do we need to be flexible that there's breakout mode and we can get an increase in volume and so forth? And again, it's not going to be a critical part of this particular workshop, but we're going to find a way to integrate these points with technical structure as opposed to worrying about Taylor, which seems to cause a lot of confusion for people. So I'm trying to avoid the areas that seemed in the past to have been muddy for people and reduce things down as much as I can so that then you can extract the content that works best for you. For today's sessions, I didn't want to overwhelm people throwing the kitchen sink at you. That is counterproductive. So we're going to concentrate on building a very core foundation. And I know about half of you have already done a workshop with me in the past. And I also have about 20 friends that I invited online who have become professional traders, but were gracious enough to spend some time talking with me, telling me some of the essence of how they got over the hump, because I can only speak for my personal experience, but I am blessed that I have a network of people that I can talk to and find out really what were some of the things that made a difference for them and translate that to you. Okay, so we're not going to go crazy with the foundation today. We're going to keep it short and sweet. Every session is going to be recorded. We'll go for 75 minutes. Hold your questions till the end of the session. Kyle will help me out there. Then we'll address them all at once. Then we'll take a 10 or 15 minute break. Then we'll do a session 2 and then a session 3. We will continue on Sunday evening at 7 p.m. Central Time. We will continue some of the educational things, and then we will also start to do our preparation for Monday morning. For me, I think the most important part of the learning process is going to be seeing things unfold live. So I can teach and show charts and show things in an abstract matter. It's not until you are there with money on the line, watching the market, feeling that uncertainty at critical points, understanding the patience that it takes to watch for things to develop. And we're very blessed here because 2 weeks ago, the markets were in a really, really crappy, noisy range with a lot of action happening overnight and not much to work with our pit session. And blessedly, that has all opened up. So we're going to have a good time next week. So we'll follow the process first thing in the morning, reviewing a game plan. We'll sit tight and watch how things unfold. I'm going to comment to you the things that I'm watching and train your eye to observe certain things. Take what you want out of it, discard what you don't. At lunch, we'll review. If there is an opportunity, we'll have more education. So what I'm not going to talk about today that we will talk about going forward is the preparation of the game plan, the execution tactics, which are extremely important. You have to feel comfortable pulling the trigger and having a concrete way to manage the trade, as well as how you enter your orders. We'll talk about, some of the record keeping that might be useful for you, and a lot about ourselves, observing ourselves, and you know, the psychology, the mental side. You know, I know just from reaching out to a few of you that the majority of people do have a good grasp of the charts, and then it's frustrating when we don't stick with the trades, or the market does what we thought it was going to do but we didn't pull the trigger, or we go a little bit on tilt. All these types of things, in my opinion, are really what is going to make or break your profitability as a day trader. I can teach technical analysis in 30 minutes and you'll have enough to work with, but it's all those other components. So I've got lots of clever ways to get around that. With that said, I am going to also mention we will give you all the charts that you see in a PDF format. So that makes it a really nice, easy way for you to go back and review any chart that you want instead of having to scroll through a video. My job is to make as many resources available to you as possible, and you will not be able to use these all in the first week. Hopefully I'll give you enough material that you can have a party for the next 6 months with this stuff. Second, I want everybody to take notes. We did this the first workshop that I did at the beginning of the year, and I hadn't done anything like that on that scale for golly, a good 15, 20 years. But it worked very well. When you write things down, you will see that it goes to a different part of the brain. And this is, I do this every day. I mean, I've got notebooks and notebooks and notebooks, and I never even go back and review them. You know, it's more, I find that I end up writing down the same thing numerous times, but when we do that, it does go to a different part of the brain than if you're just listening passively as if it were a television set or, you know, a webinar. So then at the end of this workshop, I am going to request that you send me your notes, and I don't care if they're one paragraph long. I don't even care if I can't read chicken scratch. I don't care if it's an iPhone taking a picture of it. I just want to know that you made a bit of an effort. And then what I will do is I will send you a complete synopsis and outline and of everything that was covered. And the point is that if I do that beforehand, I find that people tend to just read it and it doesn't hit with the same impact, you see. It's not until you take the material, work with it, massage it, write it down for yourself, and then you'll have a complete review at the end of the session. So I will do that for you as well. We also have certain things that we will be uploading during the week that are additional documentation for you. For example, I didn't want to go into depth on tick buy and sell divergences because we have not had so many of them the last month, and there's a reason for that I'll get into later. But yet it's still an important indicator and pattern, trading pattern, and it is starting to come back. We just had one a couple days ago. So it's just a fun little trade. These are supplemental trades. So sit tight. I'm going to make myself go off video. I just wanted to say hi to all of you and welcome, and we're going to launch into the main program. Okay, so everybody can see my screen. And just as a cursory thing, it is 5 of 9, so we're going to continue on for an hour here. Risk disclosure, okay, you guys all know that. Please, I'll just say this one last time. We did have a problem. The last time I did something like this, I found the content posted in Vietnam, in India, in Hong Kong, in Singapore, and I had to go to very expensive lengths to have attorneys work with foreign attorneys to get all this stuff taken down. So I know that there may be 1 or 2 people that have the intent to you know, distribute this for third-party profit. And my son-in-law works for one of the top IP firms. He's a specialist in intellectual property. And before we started this, I'm like, Adam, how can we nip this in the bud so I don't have to stress about this in the future? So we've embedded security threads and everything. And he does a lot with protecting digital music and photos and so forth. And that same technology is available to us today. So I don't mind you teaching this to a friend because that is the best way for you to learn. For example, if you were just to take the slides and show it to your buddy, that's fine. You explain things and, you know, that is how you learn, but don't sell them, please. So no more said about that. Moving on. Okay, let's jump down into the meat of the matter. I have a friend that I invited who is on with us today, and this was just from a little conversation a couple days ago. He actually is in Croatia. This is the beautiful thing about this business, is that we can trade from anywhere in the world. And not only that, we have 3 time zones that we can trade. So you'll see that the principles that you learn in this workshop actually could be applied equally to Europe and to Asia sessions with a different vehicle. So I was asking him about his process of becoming a trader and how long it took. And surprisingly, you know, I've always said, okay, it takes 3 to 5 years. Part of that process is that, number one, we have to see bull markets, bear markets, noisy markets, low volume and high volume. And that whole cycle in and of itself takes 3 years. So if I gave you one little pattern that was a simple continuation pattern, you might be able to get away with that. But really, this journey is about, that journey is a whole lot more. So learning to put things in proper context is extremely important. I would be willing to bet that 95% of the people out there have never seen the type of current environment that we are in now, because I see a lot of people trying to fight this. Oh, it can't go up forever, etc., etc. But if you were experiencing the rally that we saw in 1998 and 1999, especially with the tech that was just coming on board then, there's a lot of parallels, and it's really no different than what we saw back then. Just for fun, I posted a chart to Twitter last week that was a chart of General Motors, and it was from Schabacher's book. Part of my job when I talk to you is to impart as much market wisdom and lore as I can, because I am a big proponent of all these masters, these real masters from the 20s, 30s, 40s, etc. So they're sort of my teachers still as well. So I posted this chart of General Motors, and you wouldn't believe some of the pushback that I got. Oh, you know, gee, da 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 da, you know, it's dead now. You can just see there's a lot of skepticism out there. So part of the process is that we have to see all these things in context. What's happening now is really not so different than moves that we have seen in the past. And of course, we just have a much greater monetary driver. So that part of the context is one thing. The second thing that takes more time than people realize is finding the style that works for you. Not everybody uses candlesticks. Not everybody's going to gravitate towards a market profile. Not everybody gravitates towards one indicator or the other. I have a friend who spoke for us a year ago. His name is Hans, and he was a client originally 20 years ago, actually longer than that. I used to run a little online advisory thing where I would just send out the game plan for the next day. And so he was an original fax subscriber. And so he's been doing this full time for more than 20 years. After all this, now what he does is he'll go in and he'll make 2 trades a day off of a candlestick chart, holding time 5 to 15 minutes and walk away. And that is what works for him. but it's taken him 20 years to come to that conclusion. Personally, I can't do that because I can't watch candlesticks the same patience and the bar by bar. He did follow Al Brooks bar by bar for 4 years before he said it finally sunk into him, being that discriminating on finding one or two little spots. So that's what works for him. So first we have to see all these different market environments. Next, we have to come to a style that we feel comfortable doing consistently, and that can take 3 years. And lastly, now this is my friend who finally feels like he can make a good living as a professional trader. And he said it took him actually 8 to 10 years, but he had kind of taken a journey 2 years to do some other businesses. I could see and feel my roadmap early on, but it took years to gain the confidence. It's all about the whole process. So I'm going to teach you a lot of things this week. You'll see me trade. That will help the confidence process. Knowing that you can run a 4-minute mile is a good part of the equation. So you'll see me trading and managing trades and initiating, and we'll all do this together. But still, for you to gain your own confidence does take time. And then lastly, his biggest problem, he said, was himself. And this is true with all of us. We're always the ones who get in our own way. The fact that I didn't have a realistic expectation did a lot of harm. So I'm not going to be a Debbie Downer for this workshop, and I certainly don't want to do any buzzkill, and I'm certainly not going to lecture people, but the fact of the matter is that some people have unrealistic expectations about percent return, number of winning trades, these types of things. And he said he started off with a $15,000 account, and it took him a while before he realized his first goal had to be to simply stop losing, not about what percent you were going to make and so forth. Now, the next thing he said is that you must learn to trade in context as well as structure. That took him a while. And he was also trying to satisfy other issues in his life with trading, and that was not going to work. So the people that do best in this business have already resolved a lot of underlying things in their history, be it, maybe they're still rebounding emotionally after a messy divorce or a life incident, okay? We can still enjoy the markets as a passion and study and hobby, but you can't use the markets as a distraction so that you're not thinking about other things that need to be resolved. And then he felt that, hearing this saying that it takes 3 years to learn how to trade only created more anxiety. So anxiety and stress are the biggest killers, and I'm going to give you guys lots of tricks to eliminate that anxiety and stress. I already told you the first one is simply by taking a pencil to a piece of paper and writing something down. It can be anything. A trader has to learn how to eliminate these other things in their trading that cause anxiety. So it took me a while to learn. If I came into the markets and I had a losing position on my sheets right when the markets were opening, immediately the day's starting and I'm filled with anxiety how to deal with this. Or if there's something that's not working out that like I thought it would, perhaps it is hit your stop, or if you have a time stop, but it just doesn't feel comfortable and it's not doing what you were expecting it to do. Sometimes we want to sit there and give it the benefit of the doubt so that it will resolve. And now Kyle's seen me. I'm pretty brutal. If I see something that is not comfortable or is losing, I'm pretty good about just banging it out. I don't even want to think twice about it. Sometimes I then re-enter or get back in, but the mere fact that I have that loser, in my screen causes me anxiety. it's funny, I'm going to digress just a little bit, because addressing this issue, it doesn't necessarily mean that you bang out losers at the market. I'm going to come back to this point. I just want to finish up what Chavo said, and that is, being a good tape reader and a chart analyst comes a whole lot faster than being a good trader. Okay, so you guys probably are pretty good at looking at charts and analyzing charts, probably better than you realize. So some of the things that I'm going to go over with the technical analysis and structure, I bet you know a lot more than you really think that you know, all right? And so some of this is going to be an affirmation or a confirmation that, yes, you are on the right track. Yes, you know that. Yes, okay, but this gap between being the trader versus being the chart analyst also causes stress and anxiety. It's ourselves, it's our emotional selves. And so hopefully over time you understand that that gap lessens. Back to the point I wanted to make about having a loser or having something that causes you anxiety. George Soros was friends with a friend of mine who took him to lunch, and I'll put that article that she wrote in the resource section for you as well. But the main thing is that Soros told her, and she was sort of a trading counselor, coach type of psychologist, he told her that he could listen to his body about when he was on the right track and when he was not. And that if he had a position on, even if it wasn't working, and even if it was at a slight loss to him, but he didn't feel the stress or anxiety, he still felt confident that it was going to unfold, that was a confirmation sign that he was on the right track. So it's not just that it wasn't working or it was working. It's like, what was your body's response to that? But on the other hand, if he had a position on and it was at a loss, but his body was tight and he had a dark pit in his stomach, he knew that it was a bad trade. And so this analogy is also something that we learn with ourselves over time, and as you gain in experience. You'll start to recognize with experience when you are feeling confident and comfortable versus when things are very muddy and we're in that marginal land, okay? And marginal land leads to sloppy trading. So here's our plan of attack now going forward. This is our outline for today. We will start with a foundation of technical analysis. I was sort of surprised that maybe 35% of you only said that you feel comfortable in this area. And you'll see, if you know me, technical analysis is something that I can teach in almost 10 minutes, all right? It's not a complicated thing. We don't look at Ikimucho and Fibonacci and all these little intangibles. We just want the basics. Now we're going to add some structure, and I'm going to show something that I've never shown before, these time of day functions that help us chunk data. And this is back to all my original work that I did for the first 10 years with doing these swings during the day. And you can actually delve into a wonderful statistical world for those of you that are bent to see, oh golly, okay, between 9 and 10 Central Time, everything I'm going to use is going to refer to Central Time. Between 9 and 10, we had an upside bias 80% of the time in the last 20 days. So you can do that type of work. In an uptrending market, in a bull market, the last hour has a positive bias 80% of the time. So you can do a lot of statistical work just looking at these little segments of the day. And so this is important because we can only process data for 90 minutes at a time before we deteriorate in our cognitive abilities. You have to get up, you have to take a break, move around so that you can come back and be fresh again for a next segment. So hopefully this will make it into little bite-sized chunks during the day. And everybody seems to find that they trade better in the morning or better in the afternoon. So keep that in mind. We're also going to look at types of days. Some quick examples: a trend day versus a rotation consolidating day would be a one contrast. A high volume day versus a light volume noisy day. A day that trades low to high versus a day that does a morning check mark. So these are types of days that can create context for putting our trades in place. Always supportive factors for confirmation or non-confirmation. And even if you only look at one index, things such as an expansion in range in the first 5 or 10 minutes can be a confirmation factor, or perhaps volume. We also have at our disposal market internals, other indices, stocks, but I want you guys to take this content and be able to trade an Australian index, or in Hong Kong or in London. Maybe you don't have all these things at your disposal. Okay, and then lastly, really important, getting the main idea right. Okay, this conceptual, what is the play for the day versus short-term scalping patterns. So we're really going to work on getting this main idea right. Later on in this workshop, I'm going to show you fun little scalping patterns that may or may not fall into your lap if you're sitting in front of the screen. Your average holding time might only be 5 to 15 minutes at most for this type of trade. It's a really tough trade to depend upon if you want to make a living. It's not going to get you there. But on the other hand, it's fun, and why not, and it's a little supplemental part of our program. We just don't want to overdo it where we're over trading and we start to get caught up in the noise, which is a feedback that I got from several of you, that it's this challenge of dealing this noise. We're not going to get to this part of the plan today, but we will be going over preparing our plan. We just need to start off with one idea, execution tactics, and seeing trades made, knowing that you can run that 4-minute mile, adjusting our expectations, coming to know ourselves. I'm not going to hit that over the head in our session, and the psychology part, as you well know. Okay, why are we talking about day trading? Number one, we can take advantage of short-term technicals that really aren't going to serve us if we are swing trading or position trading. If anything, short-term technicals can cause a trader to exit a good position too soon. That is what I see. Oh, it's a 5 or 15-minute sell divergence. I better get out, and then you never get back in. So the day trading part, we can take advantage of these short-term technicals. That's what we rely on. The second factor, we're eliminating overnight risk. That in and of itself is huge. We sleep at night. We don't have the stress or anxiety when we're flat and we don't have positions on. Okay, the next thing is that we have to have a market that has enough length of line. What is length of line? Imagine taking the zigzags during the day, the swings up and down, and laying a thread over on top of that, or a piece of string, and then pulling that string from end to end, and you'll see that it triples in length. That's your length of line. So we need a market with tradable swings. Nobody's going to go out and day trade corn, you know, or General Electric. Okay, you're not going to, maybe you'll trade once a month, you know, there's something to do in corn or General Electric on a day trading basis. But we need to have the swings and volatility. And if we don't have that, we're at a huge disadvantage. Okay, we're also, this is pros and cons. You're much more dependent on your own physical and emotional state when trading on a short time frame. So we have to be mindful of this. If you do not get a good night's sleep, that's going to be a problem for day trading. It's not going to be a problem for trend following or investing or even putting on a swing trade that you plan to hold for a couple days. So our physical and emotional well-being is going to be much more important for ability to conduct market operations during the day. The other thing that people don't realize is that it can be wearing to continually generate new trade ideas. You have to, once we've closed out a trade, even if we were holding that trade for an hour, okay, now we have to move on and look for the next trade. That is energy draining. So we're going to have to recharge our batteries. One of the problems with day trading is that people get burned out and they don't even realize it. Also, having patience. Okay, so these are just, I don't want to be Debbie Downer, but these are the last little things I'm going to say. You do not need to be a master of all styles. You'll do best if you concentrate on one. Everybody has a time of day where they perform best. Like I said, I don't perform best in the first 15 minutes. I have a friend who refused to ever make a trade in the last hour because he was tired and he would want to make counter trend trades, and that was where he would get into trouble, looking for a counter trend trade in the last hour. So after realizing that 80% of his losing money was coming in that last hour, he simply said no more. I mentioned in the book, that the Trading Sardines book, that I had these two French interns for a summer and gave them a project to come up with their own trading style. And one was very much a counter trend trader, fading everything. And he learned that you only do that after the first hour and a half of the day. So after the first hour and a half, which he would let pass, he made counter trend trades around lunchtime and was very successful at just that little block of time. His buddy did exactly the opposite. He was trying to get in early on the day. He used an MACD. He took a lot more heat, but he also had much bigger wins because he would hold for a much longer period during the day. So each developed their own style based on time of day. Entries into the morning have more opportunity. There's more uncertainty. There's more volume. There's more range. Opportunities in the middle of the day, you might end up with small trades but a higher win-loss ratio. Too much information is a distraction. So I'm working really hard on this workshop to reduce as much down to the essence. Same thing with indicators. I'm going to show you guys several different ways that you can display data. I'm not a proponent that you have to use a stochastic, or you have to use an RSI, or you have to use a moving average oscillator. I want you also to be able to see things without indicators, but you know, there are some just little crutches that help us process information more expediently. In the long run, it's up to you to arrange your playing board. Do you like to use moving average ribbons? Do you like to use Bollinger Bands? Do you like to use a Keltner channel? Everything I teach you, you could use any of these as supportive information. So it's not dependent on one indicator. It's always dependent on the price and the patterns in the price. And then lastly, as you go through this whole week, all you need is one bread and butter trade, one simple bread and butter trade, and we'll look at examples. I just want to sum this little segment up with a quote from Schabacher. I have several heroes in my trading arsenal. Schabacher is one, Taylor's one, Wyckoff is one, and Humphrey O'Neill wrote some good wisdom as well. So any times that I start to have doubts or experience uncertainty that am I losing my way, you know, usually it's just because the market's light volume and noise, I always go back and I reread the works of the masters that I respect. Schabacher, we think of him as being the grandfather of chart formations. He was the one that gave the charts head and shoulders, triangle, cup and handle, these types of names all came from Schabacher. So he's sort of one of the grandfathers of true technical analysis. Now, I know some of you probably have heard of Edwards and McGee was Schabacher's nephew. So you'll see that their work very much is laid on top of his work, but he's still the grandfather. So what might surprise you is that most of these grandfathers of technical analysis also were very well versed in short-term trading, including Schabacher. And he writes quite a lot on day trading psychology. So trading implies short-term operation. The principle of time is much more important. Yes, because we only have a limited amount of time during the day, and the opportunities don't present themselves for more than 5 or 10 minutes. The trader takes more risks than an investor. I bet that's a surprise to a lot of people, and for that reason often suffers losses instead of gains. But also for that reason, our profits as day traders and short-term traders can be much larger than the investors. Now, I know that might seem paradoxical in this last environment that we have been in the last year, where investing, you could throw darts at the dartboard on any of the relative strength leaders and you're up 100%. But we might get this type of environment that we are in right now only once every 20 years. And so for an investor, after this cycle is spent, he might have to wait another 7 or 8 years for that same type of opportunity, and it's probably not going to come close to the environment that we are in now. And the trading requires infinitely more skill, more pains, ability, knowledge, and practicality, all other qualities than does investing. So for those of you that think that day trading is a shortcut and an easy way to go about market operations, as opposed to doing the homework and patience that it takes to unfold for opportunities for 5-day trades, 5-week trades, investing, etc., you're wrong. Short-term trading requires a lot more work. And the technical factors are what we rely on. We're not going to look at fundamentals. So we're just 100% about technicals. Those of you that know me know that I ignore news. I don't have a TV in my office. I'm not reading up on any of the fundamentals. I am aware of seasonals and especially seasonal tendencies in the market around holidays and things. We'll look at some of these later on. Yale Hirsch used to publish Stock Market Almanac. Art Merrill was the first that really did statistical work with these biases that we see around holidays. They're very powerful. So we want to be aware of these types of things as a day trader, to know that the day before a holiday can be a really powerful up day, or just like we saw Friday, that the 2 to 3 days before the end of a month and the 2 days at the start of the new month have a very strong positive bias. So that kind of information is good. The fundamentals are going to get in our way. So let's start getting down to brass tacks and building some structures, supply demand. That's what technicals are all about. You can read this stuff later. We need 2 data points to define support or resistance. So once you have 2 data points, you can draw a horizontal line. So for me, 90% of my analysis is drawing that horizontal line. We can draw that horizontal line at the previous day's high or low or a gap, and we can draw a horizontal line where we have defined support and resistance. And you would be shocked if you projected these lines into the future, how many times the market will come back to revisit them almost to the tick. So for me, that is what being technical is all about, the way the market respects these levels. All we know that higher highs and higher lows create trends. Now you would be surprised because for fun, after I had been trading for 10 years, I joined the MTA, and I had a good friend, and he said, let's get our CMT designation. Let's become certified market technicians, which of course doesn't mean much to be a trader. And I found it too much to bother with after the third component, so I never did get that designation. But on the very first test and first study material, one of the questions was, how do you define a trend? And you know, I had to think about this. Well, is it rising moving averages? Is it when 2 moving averages cross? Is it when price is above the moving average and it's going higher? So no, the classic definition is structure with the swings, that you have to have higher highs and higher lows, and we'll look at the sweet spot in the data there. And then lastly, these consolidations form chart formations, sideways lines, and I know that a lot of people were frustrated by the sideways line that formed 7 or 8 trading days ago. If you remember, it was an extremely noisy period, and we could draw a line through the way that the price rotated back and forth, and it was really crappy trading opportunity. Very easy to get whipsawed, caught on spikes, just like the gold and silver markets were doing over the last 2 to 3 weeks after that ginormous trend move up. So the market starts to consolidate by forming these sideways lines, and they were actually put forth as being a component in technical structure by Charles Dow. So now, instead of getting frustrated when the market enters one of these incredibly annoying rotation and forming a sideways line, or coming into balance, or a bracketing market, there's lots of semantics for this. Instead, we need to reframe it that the market is building up power, it's building up opportunity and energy that's going to unleash itself. We don't know when, but eventually it's going to create one of the better trends. And that's the environment that we really just started 5 days ago. So we're going to use a simple diagram. I show this every webinar I can because it just is a way of providing something in black and white. In an area where we have so much gray and ambiguity, at least we can give something to the computer and say, computer, tell me, you know, are we in an uptrend? Are we in a downtrend? Did we just make a trend reversal? So I always default to the fact that the computer says this is the environment. Now, one of the problems with doing that is that you can't define a trend reversal until a little bit after the fact or right as it's happening, and it's not always the ideal trade location. The second issue is that even if we're putting this question to a computer and it's black and white, it doesn't mean that it's going to lead to big opportunity. But we have to have something that we can hang our hat on as a departure point. Arthur Merrill wrote a book on the swings in the markets, and he was the first to quantify this. And he did it in terms of the percentage swing up or down. So you can do it that way. We're looking at this with an average true range function, an ATR function. So we'll see ways that we can make things black and white with no ambiguity. You know, people think that Elliott wave is black and white, but you ask 3 Elliott wave masters and they'll all come up with different conclusions or different counts, and that just in the long run is not going to serve us. So I'm not an Elliott wave person. But now we'll see what this looks like on an hourly bar chart. And this swing line here is plotted automatically on CQG. I have noticed that most software programs have some type of function like this. It's different than the paint bar rule that you see here that colors the bars red or green. And, you know, the formulas are public knowledge. For those of you that have TradeStation, I can provide you all of this. We'll talk more about that later. I don't want to get bogged down into that now, but you know, for our purposes, I'm just going to draw your eye to 2 things, and that is, number 1, the bars turn red like they did right here only after the market is down from the swing high. And even when it turns red, because we're in such a strong uptrend, this could actually be the low of the bar. So it is not a trading indicator. We cannot create mechanical systems out of this, even though Wells Wilder, which is where we got the formula, called it a volatility stop and reverse pattern. For now, we're working on getting the main idea right and trading patterns and trading setups and analyzing structure. So you see that we are in a steady pattern of higher lows. Even here where we made a lower low, this was more of an ABC down, if you will, or a little bit of a bear trap. The structure was not such that we had the lower low and then we took it out. It was just this data point right here. It was a lower low that just served as a springboard for a new leg up. So big difference there. What you need to think of when we do the trend reversal process is doing that ABC down and then taking out that low. And you'll see it ends up forming often a head and shoulders top or an inverse head and shoulders bottom. And the reason why this is so important is it provides one of the sweet spots in the data that we can get better risk reward. So we'll touch upon this later, but anytime that you have an ABC, call it consolidation, and it can show up as an ABC down in an oscillator that sets up a buy divergence, or it doesn't have to set up a buy divergence. It can just be a simple ABC. But this 2-part wave is important because now you can see that the price has traded through a level multiple times. And the more a price trades through that level multiple times, the bigger the profit potential. Not always, but a lot of times. So this is where there is a sweet spot in the data when you form these lines. Here, it resolved itself to the upside, and here it resolved itself to the downside and was the start of a down trend. Don't worry about getting that solid. Now we're just going to see a few examples. So this is our month of August in the S&Ps. And so far you can see that this whole month we have remained in a solid uptrend on the hourly charts. We never saw that here was an ABC down, and yes, we did trade below that right here, but we had made a higher high first. So it sort of resets the count there. And this just ended up being, remember I said that big old noisy sideways line that set the foundation for this trend that we've been in now. So you see how you can just simply take a horizontal line, draw it through the data, and voila, then it unfolds again. And you can apply the same trick if it's 2-minute data, 5-minute data, or daily data. It's just a good, solid principle of technical analysis. Let's look and see what the bottom looked like after our pandemic crash, just to reinforce this concept of trends and trend reversals, and then we're going to do away with all of this. So here we have our higher low and another higher low. And what I want you to think of is see how you made this ABC up on these swings. So once we traded above that high, the computer now says that we are in an uptrend. And sometimes uptrends might just last a little couple bars or a couple swings, and then we start to form a downtrend again. But the computer said that we have been in an uptrend at this point. Here we have the ABC, but we never took out this low. So this bottom that you see here on the hourly pit session data has been the only time that you had a trend reversal this year from down to up. Since we put in this bottom in March and did our trend reversal that first part of April, we have been in a steady technical uptrend ever since. So if you felt confident with that analysis, you know, it can alleviate anxiety thinking, oh my gosh, we're getting too overbought. Oh my gosh, you know, the fundamentals don't support this. Oh my gosh, you know, everybody's going out of business, so forth and so forth. And we don't want to do that to our mind. We want to be cut and dry, just like you are a backgammon player, or you're playing chess or checkers, or you're playing cards. We want our technical mindset to be that same, not worrying about, oh my gosh, what if my opponent has this card or that card? So even here, this was an interesting period because we were in May, June, and July, and we're always going to default to the computer. So the computer sees this A, and then the lower low, B down. So on a higher time frame, it was just an ABC down. But we never then put in the lower high from this and took out this low. If you saw this structure here and this started to roll over, it could be early signs of a trend reversal, and a very aggressive trader might want to start to position themselves accordingly. And even here, you see this is just part of a bigger consolidation. The computer always maintains that we are in an uptrend. You have to take that lowest low, and then, so even though you have this little ABC lower low here, it didn't take out this low. So we draw the major lows all the way up. And again, this is where we are today, and I just showed it on pit session data. That previous chart I showed you was 24-hour data, but you can see our line that we formed up here, and this line is now unleashing itself. So we're going to have an interesting dynamic environment this coming week because there is no top currently in sight. We haven't even begun to think about that. Let's just look and see how we can do this on short data, and then I want to show you what two past tops on hourly charts did look like. Now, I've been using this for oh my goodness gracious, over 2 decades. Okay, so I feel really comfortable with it. And this I thought was fun because this was a 300 tick chart at the time that the S&Ps were at this level. So this was many, 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 many years ago. And you can see here on a short-term basis, this ABC down, and then we took out that low. So right here was your trend reversal, and then our first real shorting opportunity in that downtrend. This is also a great trade, and it's easy on this to see how well behaved this data is. There is no noise, there are no obnoxious spiky tests. This is over just a 1-day period, and this is pretty similar to a 5-minute chart. Now let's fast forward and jump to today. A 400 tick chart today is the equivalent of what a 300 tick, 4,000, a 300 tick chart was 20 years ago. All right, so we have so much more data, so much more volume, so much more activity, so much more range. I hope you guys appreciate that. On one hand, 20 years ago, we had less noise and well-defined points, but you were only getting small pieces because the range was so much smaller. So here on this particular time frame, we see a trend reversal process where we had this lower low and then we took it out. So the lower high, this ABC down, if you will, and so this was a trend reversal down. And then this here, the inverse at the bottom, first higher low, second higher low, trend reversal back up. So we can be in uptrends on one time frame and downtrends on the other time frame, and we're not going to worry about that for purposes of this workshop, but I just wanted to nip that question in the bud. And we will find out ways that we harness and work with this going forward. The other thing is you can see some trades work right away in a big way and other trades don't give as much, and some trades turn out to be nothing at all. This is trading. So when we go and we make trades, we're thinking about a series of 20 trades, and 4 of them are going to be home runs, and half of them are going to be annoying, and another half just might not pan out to be anything. So you must accept that. If you go and you like playing cards, or you like playing bridge, or you like playing poker or blackjack, any of these things, a lot of times you're just going to be dealt marginal cards, and you have to know how to deal with that and work with that. Basically, you don't bet big when you have very marginal cards, and I don't want to play a bluffing game with the market. So we can see this dynamic environment of readable swings. All right, it's, oh golly, all we have to do is find little bear flags and we can make a great living day trading, right? And then this nice base and buy the pullback after the gap. So this is where sometimes it can be a disservice not to really understand that our challenge as day traders are when we hit this crap. And this is where people tend to lose more money than they need over trading. And then this is, of course, ultimately which will lead to the bigger swings. And this funky environment continued on for another couple days with a broadening pattern, making higher highs and lower lows. We're not going to review that. But you as a trader are going to be dependent on your ability to assess how probable that particular trade entry is. Okay, is it marginal, or is it one of those ones where you should be doing all your major size or line? We're going to talk about position sizing later, but you can see your ability to discriminate between environments improves with time. And that's one of those learning curve humps that people have to go through and get over. Let's go back now and review what these trend reversals look like on an hourly chart. And my point in showing this is twofold. I was seeing a lot of anxiety out there about this current markup that we're having. And people feeling, is the top in place? Are we getting close? How's it going to unfold? And is it time to buy puts yet? And so forth and so forth. And this process of doing a trend reversal, or bottoms are actually much more V bottom than tops, but this process of making a trend reversal is exactly that. It is a process. It forms swings in both direction. You know, whether we're looking at a daily chart or a 5-minute chart, watching for that trend to come to an end, you have your automatic reaction, the retest, a higher high, a higher low. All these sorts of things are a process. So for now, with our current structure, any pullbacks are still going to be buys. So this is what happened at the top, and this was this year. It was just not that long ago, but this is on an hourly chart in the SPY. And wait, I beg your pardon, this was not this year. I just saw my date that I captured this slide. Because we haven't had a downtrend this year after April. This was the year before. So you see, here is a typical thing. We see this shortening of the swings. That's a loss of momentum. Reaction down. Here's where it makes your ABC. Once you took out this data point, the computer says you're now in a downtrend. You still had a sharp reaction up, but it didn't take out that high, which would have then negated the downtrend. You can create a statistical system that can trade these things automatically, and you will find that you will drive yourself bonkers if you were to absolutely watch that. And it's like any system, it has a series of losers and so forth. So I just want to emphasize it is not mechanical go short here. It's a mechanical function to derive context. So we have our lower high, and then the trend accelerates as it continues. So this was one process, and we can see that going forward in our trading over the next couple months. Here was another example where we actually saw this ABC, and now the computer says that you are in a downtrend. You have lower highs, you have lower lows, and voila, then there's some opportunity for the shorts to have some satisfaction. So if we know these things, we can alleviate stress when the market is moving into uncharted waters, such as it is right now, such as the NASDAQ has been doing, or individual stocks. We don't care why it's doing what it's doing. We don't care about the fundamentals. All we care about are the little technical swings down and up. Now this downtrend here that started led to that ginormous flush into the end of 2018, if you remember. I know it seems like it was 5 years ago, but this still had another leg down from here. And so that is what happened here. And this ginormous flush into the beginning of 2019, here's how we then reverse that. You made your higher low. So you had your automatic reaction up, your higher low. Now the computer, for me, I just go by the green and the red, even though there's a little jiggle here. You have your second higher low, and then you took out this data point you turned up. So it wasn't until here that you actually reversed to an uptrend. So it doesn't mean that we can't trade from the short side in an uptrend, and it doesn't mean that we can't trade to the long side in a downtrend. You have to have some definitive way of providing structure. That's an absolute. And so this is the way that I use. Now we're going to reverse everything and start from scratch. No colored bars, No zigzags, no oscillators. How do we make sense of all this data? Because this is what we are going to do every day when that market opens and we can't see what's going to happen over here on the right side of the charts. Because this is what we're trading. This is what causes the stress and anxiety. How is the price action going to unfold? Don't tell me what we did in the past, gosh darn it, I can see that. So how are we going to start our operations moving forward? The first thing we're going to do is the horizontal lines that mark off the levels, because this is where the market found respect before. So you see 2 data points. This was a great support line. 2 data points here. This is a great resistance line. The middle of the range would be what you would call your value area or your high volume distribution, 50% retracement, you know, whatever you want to call it. It is still an important reference point, though not as visible as these 2 points here. So we're going to carry these points forward because this was important for the market psychology. And you can see when we had this reaction up here, how it almost to the tick found resistance there. And how many times do we see this with the intraday charts? It's so technical that we just test a previous higher low almost to the tick. Sometimes we fall a few ticks short, sometimes we go a little bit through, but it's a very technical level. So if it's just a simple swing low, then we can just put a little slash under it to help highlight the fact that this is forming a consolidation, a shortening of the swings. A loss of momentum is also an equilibrium point that then can lead to a better move up. So let's go forward and see what happened. Here was our little consolidation. It led to a bigger move up. Notice the play around the middle of that prior range. This is really common, that if we have a false breakout from a big rectangle range, we'll often start to rotate in the middle of that range. It works on 5-minute data, 60-minute data, daily data. So we did our rotations around the middle of the range, and then where do you think we're going to go to? We're going to test the upper part of the range, and there we did. So we see this throughout the day just on a short-term basis as well, these tests of the previous day's high and low. So no oscillators, no color rules, no moving averages. We can just look at the simple levels. So that's always has to be our departure point. Any market you trade, any time frame, it's about the levels. And then, of course, we enter into a different type of tool set once we're truly channeling like we are now. I mean, who can say there's a level in Tesla? There's no levels in Tesla. There's just a channeling market. So when we pulled back here, notice that it was almost to the tick, this level here. So that's very important going forward. And the back to the little bit of play up here. 2 concepts. Auction theory. Test reject represents a failed auction. And this is going to be one of our most important trading patterns for day trading, the S&Ps, or that matter, any market, is when that market opens, does a flush down in that first 25 to 35 minutes and comes roaring back. That is your test reject pattern. Otherwise, it's going to be a continuation pattern. So here we didn't do a sharp test reject like we did down here, those big FU spikes. I'm going to take my liberty with my language. And then when you came back up to here, we started to play around with that level more. So during the day, if you start to see a market trade and rotate around a previous day's high, you're increasing the likelihood that it's going to then blast through. Not always, it can be resistance, but it's going to increase the likelihood that you can get on your guard for a new swing up. So once we've done all of that process, notice now how we started to form a line. Now, just to put it in reference, you see this 280. This 280 was our previous resistance. Here it is 280 again. I'm just advancing the charts forward, and here is now our 280 level, and we're really rotating around it. We're building that sideways line. This was that obnoxious type of trading period that we had 7, 8, 9 days ago. Thank God that has passed. I was praying it would pass before we entered our workshop live trading, because it's a lot more fun to catch swings than just playing for little small scalps, which is what we do in this environment. You know, you play for small targets, you get in, you grab whatever you can. You're more likely to scale out in this type of environment than you are when you get those good readable swings where we can maximize our gains. But now you see how this sideways line area, or big fat belly of a profile, or volume distribution, if you have any of these things plotted on the side of your charts, led to a channeling market up to here, at which point we started to coil again and, of course, retested our lows. So let me just go back, and this can provide a good enough foundation. The thing is that you have to actively follow this, meaning for those of you that were with us in our trading room, which we have had now since April, a little small core group of people. We haven't really marketed or advertised it, but it's our trading room. And you will see that on my main grid, something that you guys will see on Monday, we are always rearranging our lines as the market structure changes. So when we're in a trading range, we're marking off and we're setting the levels. We're setting our game board up for that day. And then once we break out and we're starting to channel, we can draw up-sloping, really loose trend lines. I'm not one for tight diagonal lines, but just to get the main idea right of higher lows. And so it's an active process going forward, circling the highs and lows and making sure that they're there in the forefront of your analysis for each trading day. It only takes a minute. Doesn't take any longer than that. So that's for you where the real learning continues to come in. Yes, it's important to study past data, but the market never does the same thing the same way twice. So we can get general ideas. People that want a very specific setup, oh, the breakout from a Bollinger Bands and so forth. It's a legitimate concept, increasing range after low standard deviation readings. But you will see that plays out a different way every time. Sometimes it goes a little bit, sometimes it's a failed breakout, sometimes it goes up so high or low that you wish that you had done it 3 times the size. It never happens the same way twice. So that's why we are always marking off our levels, drawing rectangles around the trading range, marking off sideways lines. You can print off a chart and do it if you want. You can just make one note on your computer. You can just write a little note to yourself. Whatever works best for you and is not going to take up too much time. What I have found is that for day trading and trading in general, we need to have these things set up well beforehand. When the day starts, that should be the easiest part of the day. It should be where we can sit back and see how our game plan unfolds, or be patient and wait for a level to be tested, or wait for that buy or sell divergence at the end of a swing. I don't want to be, let me pull up this indicator, let me try this moving average. I don't want to be messing with the mouse and doing the analysis mode, the chart mode. I'm now wearing my trader hat. I'm in my concentration mode. And the challenge for me is always, if I'm going to talk or teach or give commentary or feedback, that's a different mode than my trader mode, where basically I'm a pretty good poker face. You're not going to know if I have a winning or losing position on or what my cards are. I'm very good that way. I mean, of course I'll tell you guys, of course you'll see that, but I'm just saying in general, we have certain modes of operation. So do your analysis mode and your preparation and your game plan mode before the markets open, or before you're going to be in your trading mode, which is a whole different ball of wax. When we continue, we'll take a 5 or 10 minute break so everybody can stretch their legs, drink water, and we're going to start to get to some more conceptual things now that are not just this boring line and levels stuff. And you'll see we're not going to stick oscillators up and do chart formations yet either. That's going to come last. I want you guys to appreciate how much you can do without all the indicators. Your ability to see and feel in control of the market, or possible spots where there might be riper opportunity. I want you guys to be able to feel and see and get comfortable with that idea before we start adding all these things that are helpful, but they're a derivative of price. Okay, and the reason is because I feel that that is what really gave me my edge. 10 years of trading without intraday charts, without intraday indicators, having to, wait it out and make sense of the markets sloshing back and forth. And it's a process, but I have also seen people do this. I know it can be done because I've seen many people do it, and I know you can do it as well. And then you'll find once we add all the little fun oscillators and chart formations and buy and sell divergences on top of that, you'll really enjoy it. But we're going to get through this other stuff first. So we'll just reconvene here, and we'll make it 10 after 10, and get some water. Everybody knows I preach, drink water, drink water, drink water. And if you hear me preaching something, trust me, I'm lecturing to myself. I never mean to preach to other people. I'm really always being my own teacher and minding myself that I need to drink water. But stay hydrated. We'll reconvene in a few minutes.